Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Kevin Davitt, head of index options content at Nasdaq, to discuss what the proliferation of expiry cycles means for index options. Kevin, it's great to see you as always. Welcome back to Trade Talks.
Good to see you too, Jill. Thanks for having me.
You got it. So today's a standard expiration for index options. And given the proliferation of the expiry cycles, can you explain what that means to the audience?
Sure, I'd love to take a try. So I think this is an important distinction to understand for any index option users. It occurs on the third Friday of every month. So as you mentioned, that happened today. That's what's come to be known as standard expiration. It could also be called historical expiration Friday. So in the past, all index options were AM settled, and that only occurred on the third Friday of the month. Whereas standard equity and ETF options were always PM settled. There are very clear parameters that outline the entire process. We don't have the time to go into it here, but essentially the expiration print or value for standard index options, so those third Friday ones, comes from the opening print for all the constituent names on their listing venue. The index settlement value is then quickly disseminated and the expiring options are then cash settled. So just to be clear, this exposes an end user to what we typically refer to as gap risk or overnight risk. Now that could be a positive or a negative. So take an example where you might be long and out of the money index call option that's AM settled. And then if the index printed above that long strike, it would be fortunate because that call would then have economic value. All index options, no matter whether they're AM or PM settled, can be closed ahead of their expiration. So for standard NDX options, that would mean closing a position yesterday before the 4:15 p.m. Eastern time cutoff. All non-standard options, which includes non-third Friday expiries, as well as all the other short-dated options that expire daily, they are all PM or afternoon settled. The process from a pricing standpoint is effectively the same, except it's a closing print for all the constituent holdings on the index from their listing venue. Then the Options Clearing Corp disseminates the settlement value using those prices. The difference is you could close those positions on the day of expiration, and on the third Friday, options would need to be closed on Thursday to avoid gap risk. But keep in mind that that overnight risk could be a positive or negative depending on your exposure. Hopefully that made a bit of sense. And if there are follow-up questions, you could always email us at indexoptions@nasdaq.com.
What's your take on the Nasdaq 100 now that we're beyond the August expiration?
So I always enjoy an opportunity to talk about an index that, from my perspective, will become the bellwether for equity performance in the next decade or so. But it's important to clarify that it's just my opinion. So with that in mind, I believe that the relative importance of expiration for index options has diminished with the introduction of far more expiry cycles. Options volume and open interest is not nearly as concentrated as it was 5 years ago or even a year ago in the third Friday options. End users are really finding ways to position or hedge exposure more precisely using non-standard options. So if I shifted now to index performance, the Nasdaq 100 is higher by about 35% year to date. For comparison's sake, the S&P 500 has gained about 14% in 2023, so there is a significant performance gap. I think it's worth noting, and this has probably been covered, but historically, September and October tend to be more volatile months, and on average, indices tend to move lower. So a month ago when you and I were talking, the Nasdaq 100 was making a new 52-week high. The index is now about just over 7% below those levels. I think if you look through a technical lens, the Nasdaq 100 and other indices broke below their 50-day moving average this past week. The Nasdaq 100 hasn't consistently closed below that moving average since early January of this year. So you could make an argument that technically the tone has changed. We continue to see really strong option volume numbers. Last month was the highest average daily volume for NDX in many, many years. And so far, August is set to surpass those levels. Ultimately, I think that's a testament to much broader understanding of index options, more granular expiries, and ideally, I'll be able to keep pointing this out, that trend, during our monthly conversations.
And Kevin, any other market dynamics that caught your attention recently?
So last month, again, when we spoke, I pointed out that we were coming into earnings season. Now, as you mentioned, we're coming out of earnings season, and I'm going to give full credit to the Nasdaq Economic Research team on this one. So my colleague, Michael Normile, pointed out that about 80% of the reporting companies beat this earnings cycle. Now, that's a normal percentage, but the market didn't kind of quote unquote reward those companies to the extent that they have on average over the past decade. So the chart on the screen shows Q2 results for 2023 in orange, and the green bars are the averages for these 3 quarters going back, for these 3 categories going back a decade. The companies that beat estimates moved higher by about 0.5%, when over the past decade, they normally bounced about 1.6%. Companies that missed on an earnings per share basis sold off about 3.5%, which was slightly more than the 10-year average. But the biggest outliers were the firms that met expectations on an earnings per share basis. They sold off nearly as much as those who missed, when typically that's been met with just like roughly a 1% decline. So looking perhaps more on the bright side, overall, the slowdown in earnings per share was significantly less than what the market anticipated overall. Earnings were particularly strong in consumer discretionary. So in brief, the consumer remains willing to spend so far despite higher rates, and we'll see if that continues through the next couple of expiration cycles.
All right, Kevin, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.